I feel like I would be heckled if I didn't ask the CPA some tax strategies.
For
So,
sure,
so
man.
what tax strategies can you provide, the regular Joe Schmo real estate investor?
So this is a question I love because I hate paying the government money, you know. So and at the end of the day, some of the best strategies are via cost segregation studies that you get done on projects. So whether I buy a single family house or if I buy a multifamily property or a mobile home park or anything on the real estate side, you can then go through and do a front load the tax benefits into year one via a cost segregation study. You're picking apart the property into a bunch of little pieces, like the flooring is worth this, the lighting is worth this, the furniture, the appliances, everything's worth something. And instead of writing that off over 27 and a half years for depreciation, you turn that into 5 year and 7 year and 15-year property that then can be a bonus depreciation all in year one. And so you can get, 20% plus of your purchase price of your building down as a tax deduction in year one. A couple years ago, I bought a mobile home park, and I put $600,000 in, and I got a $600,000 year one tax deduction. Now you can only take this against other passive cash flow, right? So against other rental income or other passive investments that you have, right? First, then you can take it up to 25% of your or 25,000 on your salary, assuming you're not phased out by making too much money, and then everything else gets rolled forward into future years. And if you sell the building, you have recapture of that. So you want to do this only on properties that are long-term in nature, that you're going to hold long-term. Now, there's other ways to create more passive cash flow. Like we do lending over here, where if our investors are investing in properties with us and the lending side, our lending business is considered ordinary income and not interest income because we are in the business of doing loans, right? So that's business income. And so passive LP members or limited partners of our funds, which is our investors, then get passive ordinary income that can be taken against these tax deductions too. So I teach people to invest in the promissory notes because you get consistent cash flow coming in and it's ordinary income like that to be able to take these tax segregation or cost segregation deductions against, and then investing in the property side too because the tax benefits, the appreciation, which is basically an inflation hedge, the ability to borrow money against the asset and leverage it, of course,